converge completely, that is, we end up with the same relative price of cloth in both countries, the relative wage to rental rate will also completely converge. So this notion of complete convergence here is sometimes called factor price equalization. So if you're reading in the newspapers something about wages in China's manufacturing sector rising very quickly, or wages in India's IT sector rising very quickly, and at the same time you know that those are sectors that we import a lot of goods, manufactured goods from China, and a lot of IT services from India. And then what we think about the industries, manufacturing or IT, in the United States or in Western Europe, countries that have high capital to labor ratios and also very high wage to rental rate ratios. But those wage rates basically have been stagnating over the last decade or so as globalization and international trade have expanded exponentially. The explanation is this. Not that we have complete convergence, but when you have a situation where countries begin to specialize along the lines of their comparative advantage, in this case, taking advantage of the abundant factors of production that they have to produce goods and services that are intensive in those factors of production, then you should see the return to that factor rise very quickly. And in fact, that's exactly what's happening in China, in Vietnam, in Bangladesh, in India, in certain sectors of the economy. So we're seeing that over and over again. Now, notice the other thing, though, that is happening here. So we've got wages. It's the wage to rental ratio that's rising. So what does that mean about the return to capital in China? It will be falling in a relative sense, right? Wages are going to be rising faster than the rental rate, so the ratio of wages will be rising, which means the relative return to capital will be falling. Profit margins in China continue to get squeezed. Look at what's happening in the US, right? This says that the relative wage will fall, which says that the relative return to capital will be rising, and what you should see in the internationally traded sectors of the economy is higher and higher corporate profits. And indeed, corporate profits in the last 5 years have been at record rates. So while this is a relatively simple model with lots of very restrictive assumptions, it goes a long ways to explaining both what's happening to labor rates as well as profits in both China and the United States, or any other pair of countries that you want to look at. Once you open to international trade, that factor abundance determines the specialization, and the countries actually do specialize in goods that are intensive in the factors that they are abundant in. So it actually works quite well. I have no idea why there are two slides exactly the same, but it's really easy to say insert duplicate slide. Okay, so we do have, yes, I'm sorry. It will turn out that in the context of the model, well, as we've seen in the context of the model, it's relatives that matter. But notice the other thing that's happening. Relative prices also converge. The law of one price will tell you that also means absolute prices have to converge, which means that absolute wages have to converge. Now, we're nowhere near that. It takes a long, long time for that absolute convergence. I'll come back even to the relative in just a minute. Okay, so factor price equalization. So if the prices of the goods, the relative prices of goods are equalized, then the returns to the factors of production will also be equalized. So that's what that says. Now, why does this occur? The reason that this occurs is because when we in the U.S. import clothing from China, to stick with our example, so we have an increased demand for Chinese clothing. Well, in order to meet that increased demand for Chinese clothing manufacturers have to hire more workers because clothing is labor intensive. So in some sense, we could say that our increase in demand for Chinese clothing is an indirect demand for Chinese labor, or that Chinese labor is embodied in the Chinese products for which we now have increased demand. Similarly, China's increased demand for machinery, a capital-intensive good, is essentially an indirect demand for additional capital, which should raise the rate of return on capital. Okay, that's what that says. Okay. Now, you asked the question just a minute ago, does this mean absolute wages converge or just a relationship? The key is to actually realize it hasn't happened. Unless two countries are very similar in their factor endowments to begin with, then we almost never see complete relative price convergence, and therefore we almost never see relative factor return convergence. So again, if two countries were very similar to each other to begin with, there wouldn't be big differences to start with, and so one could think of convergence actually taking place. So think of the US and Canada, think of Germany and France, or Germany and the Netherlands. You know, if countries are very, very similar in terms of their factor abundances, before international trade, after international trade, relative prices are broadly the same, relative returns to factors of production are broadly the same. But when we look at countries that are very different from each other in terms of their factor endowments, the US or the UK or the EU on the one side, and China or India or Brazil or Argentina on the other side, now we're talking about big differences to start with. And why don't we get factor price equalization there? There are a number of assumptions that we made in setting up the Hechter-Ohlin model that turn out to be simplifying assumptions that allow us to get to a pretty robust model, but just simply aren't true in the real world. For instance, what we're assuming is that both countries produce both goods, and the goods are identical between countries. And in fact, if you looked at the kind of apparel that we make or textiles that we make in the United States and what they make in China, they're very different from one another. So once you have product differentiation, something we'll talk about in more detail later, but once you have product differentiation, there's no reason to assume that you're going to get complete relative price convergence, which means you also wouldn't get relative factor price equalization. Second, we set up this model under the assumption that both countries had similar technologies or productivities. Remember we said the production technology is the same in both countries. Again, that was an easy way to set up the model so we could start with two countries that had identical production possibilities frontiers and then show only the effects of differences in factors of production. So if we added in differences in productivity, then we've got another outward shift or bias in our production possibilities frontiers. And that means that you would not necessarily have complete convergence of factor prices. And of course, we know that production technologies are different. We know that if labor is very inexpensive and capital is very expensive in China, you're going to use a different mix of labor and capital than you would in the United States, where labor is very expensive and capital is actually relatively inexpensive. So that gives us two reasons for why we would not expect factor price equalization, even if we waited a very long period of time for it to occur. A third reason is that even free international trade does not lead to the complete convergence of relative prices. If for no other reason, they're transportation costs. Not just transportation costs in terms of moving goods from one place to another, but also transportation costs that are associated with crossing borders. So you've got customs and tariffs and other types of things that may be involved there. And if relative prices don't completely converge, you would not expect factor prices to completely converge either. And fourth, something that we'll look at in more detail, I think, week after next, is some factors of production will not be completely mobile between industries within the country. Remember, this is one of the assumptions that we've made, both in the Ricardian model and in this model. The factors can simply move out of the machinery industry and into the cloth industry in China, and the other way around in the United States. Well, what if they can't? Or at least they can't in the short run. Well, if they can't, then, again, we've got another violation here, and we wouldn't see complete convergence of factor prices. Now, a number of economists have done research into factor price equalization, throwing in these differences and some other minor ones, and they can point out that, yes, the Hechter-Ohlin model still works really well, as long as you account for these other issues. But within the context of what we want to do, the simple model actually works quite nicely. So we've got relative prices changing. We've got relative factor returns changing. So let's take a look more closely at what's happening to the incomes of the workers and the owners of capital. In other words, who's better off? So again, coming back to this diagram, remember we had our world relative price, and we can have this discussion just with factor price equalization, because even though factor price equalization is unlikely to be complete, the economic pressures will still be pushing us in this direction. So everything we say here can be talking about the direction of income changes for workers as well as capital owners, even if we don't get complete factor price equalization. So our general conclusion is going to be the following. The abundant factor always gains from trade, and the scarce factor always loses from trade. For most people who study economics, this just doesn't sound right, right? The abundant factor gains. The more we have of something, the more we're going to gain. Generally, when you have lots of supply, the price goes down and you lose. The scarce factor is typically the winner, and the abundant factor is typically the loser. But that's not the case here. Okay? So we can see that, again, coming back to our diagram here. Remember, China, which has abundant in labor, is going to see the relative wage to rental rate rise. So workers are clearly better off with international trade than they were in autarky. Workers who are the scarce resource in the U.S., we're relatively capital abundant, are going to find with international trade, their relative wage is going to fall. So the scarce resource loses, and the abundant resource gains from international trade. So what that means then is, if we thought about China, labor gains, and capital loses. That is, the owners of capital will lose. So let's think if we can see exactly what's happening here. So remember, from China's perspective, there's an increase in the relative price of clothing. So we can just see from the Hechter-Ohlin model, the Stoffel-Samuelson relationship, that this increases the relative wage. So that's good. It also raises the capital to labor ratio. Okay? Notice that as wage rates rise, firms will want to use more capital and less labor to try and minimize their cost of production. So we have the capital to labor ratio rising in both the machinery and the cloth industry in China. Okay? When each worker has more capital to work with, remember it's a capital to labor ratio, so each worker now has more capital to work with, this raises the marginal product of labor. In a competitive economy, that also means that the real income of workers will rise. Yes? Oh no, the capital to labor ratio is rising. We're not changing the number of workers. We're only moving workers from one industry to another. So the other way to think about it is, if the capital to labor ratio is going to rise and the number of workers in the economy is fixed, we're going to have more capital. So firms will be investing more to build up their capital stock. That's the substitution. So in the production process, so remember, in the cloth industry, we need to expand output. It's labor intensive, so we need more workers, but we also need some capital as well. So as labor becomes relatively more expensive compared to the price of capital, you're going to use a different production mix of capital and labor than you would at lower prices. Now notice, for every unit of capital, there's less labor. Right? If the capital to labor ratio rises, the labor to capital ratio falls. So now we have a lower marginal product of capital in both industries. In a competitive market, that means the real income of the capital owners has declined. Yes? No, what I mean is the real income of workers rises and the real income of capital owners falls. So workers are absolutely and unambiguously better off. Owners of capital are unambiguously worse off. Their real incomes have fallen. Remember, real incomes is talking about your purchasing power. Yes. Okay, so we find here capital to labor ratio goes up. So that means the marginal product of labor rises. Each worker has more capital to work with, so their real income will increase as well. In both industries, right? If we go back to the Heckscher-Ohlin diagram, remember we've got these upward sloping factor proportion lines that show that as the relative wage rises, let's just put in what happens in China. So notice that in both industries, I'm going to just label it up here, the capital to labor ratio will increase. So again, think about it. What the business wants to do is to minimize its cost of production. Whatever the level of production is, it wants to minimize the cost of production. So labor rates are rising relative to capital rates. So let's just assume that the price of capital or the rate of return on capital is staying the same. It won't, but let's just assume that for a moment. So wages are going up. So what do you want to do? To minimize your costs, you want to make production substitutions so that you're using a higher capital to labor ratio. Remember, we had our isoquants, which show the various inputs that we could use to generate the same output. So here we're changing the relative price of labor, so we're going to move to a higher capital to labor ratio. Again, one easy way to think about that, when you look around the world, look at the countries that have the most expensive labor. They all have lots of capital. Because in order to produce something, you want to have a higher capital to labor ratio. In countries that are incredibly labor abundant, where labor is really, really cheap, there generally isn't much capital. Because labor is so cheap, why invest in what will be relatively more expensive capital? So the production technique that you would use in any industry will be very different across countries, depending upon what your relative factor returns are. But again, as relative wages rise, in both industries, we're going to want to increase our capital to labor ratio. Now notice the way we've drawn this. We've got a flatter curve for the machinery industry, which is capital intensive. We're going to get a bigger increase here than we are here because we just can't substitute out of labor nearly as quickly. Okay? So if that's true, then again, as the capital to labor ratio rises, each worker has more capital to work with, which means that the real income of the workers rises in a competitive market. But if the capital to labor ratio is rising, the labor per unit of capital is falling. So each unit of capital now has less labor working on it, which means the marginal product of capital will also decline. The marginal product of capital in a competitive market is what generates the real income of the capital owners. Okay? So notice here, these are our workers. They're better off, big plus. These are the capital owners. And these guys are worse off. Again, when you start looking at what's happening to wage rates in places like China, where we're now beginning to have strikes and all sorts of other types of labor disturbances, when wages are rising 25% per year, then that 25% has got to come out of somebody's revenue stream. Prices aren't rising that quickly, so the only other place it can come out of is profit margins. So the owners of capital are worse off. The owners of labor or workers are better off. Now, one other thing to note here. We have workers in two different industries. We have workers both in the cloth industry and the machinery industry in China. We're producing some of both goods. Workers in both industries are better off. It doesn't matter which industry you're in. Your wages are rising. Again, assuming we have competitive labor markets where people can move around in search of the highest real wage. Similarly, it doesn't matter where the capital is. The capital could be in the cloth industry or the machinery industry. The owners of that capital are going to be worse off. Again, this assumes that the capital can be shifted between the two industries. We'll see later that that may or may not actually be the case. Okay, for the U.S., we're a capital-abundant country, so the owners of capital win. And the U.S. is a labor-scarce country, so labor is worse off. And again, if you go back to the Heckscher-Ohlin diagram, you'll see exactly the same thing. A decrease, although I've worded this a little bizarrely, this is a decrease in the relative price of clothing, raises the relative rental rate, lowers the relative wage, but raises the relative rental rate. This lowers the capital to labor ratio in both industries. Marginal product of capital increases, which increases the real income of capital owners. Marginal product of labor goes down, so the real income of workers are worse off. Now, one thing to notice is, again, who wins is the abundant resource producing the good that is intensive in that abundant factor of production. So workers are gaining in China, capital owners are gaining in the United States. Okay. I think I mentioned this just a second ago.